You've got to learn to set yourself up for success. People lose a lot of money in the stock market. If you had $1,000 and you're going to put it in the stock market, what would you do? Hi, my name is Dee, and welcome to the Money Growth Academy, where we demystify the stock market, simplify investing, and multiply your opportunities for financial success. So if you had $1,000 that you saved up, or you have, it was gifted to you, whatever it is, what would you do with it? So one of the first things is you've got to learn to set yourself up for success. People lose a lot of money in the stock market. It has no emotion. Matter of fact, it is, to some regards, somewhat schizophrenic, right? So one day it's in a good mood, another day it's in a bad mood. You can call it bipolar. I mean, you just don't know what it's going to do, right? It has no regard to people. Secondly, there is a difference between being a trader or being an investor. So what I'm going to be talking about, and what you'll hear me talk about most often, is about investing, because that's what I learned to get good at. And the other thing I want you to know is this: there's no easy shortcuts to wealth in the stock market. And if anybody tells you different, you ought to start running. This stuff isn't easy. It's just not easy to do. And so there's going to be some learning required. And but one thing I did find out, there's some better treaded paths that you can take, right? So there's some pathways you can take that some people have already gone through and have done it successfully multiple times, over and over, okay? So that's what we're going to talk about, and that's kind of where I come from. So as we talk about this, if you just give me just a moment just to talk about a few things, is one of the things, if you're going to be an investor, you're going to face this every day when you're trying to make a decision, and that is uncertainty. Now, one of the things I learned to do as I progressed in my investment career, right? I'm not a stockbroker. I don't come from Wall Street, right? So I didn't work on Wall Street. They certainly worked me over, and that's another story. That's why I learned to do this on my own. But this thing about uncertainty, right? And that's the challenge. And so here's some of the notes. I went back and I looked at some of my notes, because I journal as I invest, because I want to know what I was thinking when I bought it or thinking about selling it. I like to be able to look back in time and get an idea of the framework of my thinking. And so this is one of the things I wrote. I said, if you're going to invest, you have to learn to live with some level of uncertainty. As a matter of fact, you have to become very uncomfortable with it. And like I said, I've been doing this just about 20 years. And my first 5 years in this journey, it was kind of mixed, right? So I had a brokerage firm doing a lot of things for me. And then what I found out is that I would get my statement year after year, like many of you get, and you see that you really haven't done that well, not compared to what you're hearing other people doing, or at least the market's doing. It didn't seem to keep pace with the market. And so it made me ask questions. And I'd look at my statement, and in those years that I lost, I paid the same fees as when I was winning. And I just couldn't understand, why am I paying somebody to help me lose money, right? It almost reminded me of a joke. It's kind of an old banker's joke. And one banker is actually talking to another banker, and the one banker says, I don't know why we keep coming up with all these new ways to lose money when the old ways work just fine. And that's kind of how I felt. I found whole new ways to lose money in the stock market. So it wasn't funny at the time, certainly. But what I want to do is share with you some things that I've learned, and in any video that you see me do is going to kind of take you to that journey, so you don't hit the same potholes that I hit. So yes, you're going to have to read some books, because I did. And yes, I went to some seminars and I learned some things. And so I'm going to share a lot of that. Here's the thing is, the only thing, even after years of investing, the only thing that I've become certain about is that at the end of the day, after all my research, I'm still uncertain, right? I feel a little better having done the work, but I still have a level of uncertainty. And so here's a little note, again, that came out of my journal. It says, what I try to do from an investment strategy or investment, and when I'm making investment decisions, is to minimize my total exposure to the negative impact that can be caused by risk. And then at the same time, position myself for a reasonable upside over a given period of time. There's just some things you just can't know. Will the manager and the company do something stupid or negatively impact the brand, which ultimately impacts my investment? Has a decision been baked into the business plan of the company, right, in the past that I'm not aware of today? And those decisions, do they have unintended negative consequences on the business in the future? Now, think Wells Fargo about a year or two ago with all that shenanigans that was going on with Wells Fargo. There's just some things we don't know because we're not on the inside. And other things are like, what impact will global or domestic political events have on the company? Will short-term or long-term lending cycles close earlier than expected? These are some of the things that I wrote down and have captured over the years as I've learned to invest. So when it comes to investing, there are things I just can't know and I just have to accept. And we all have to accept, right? Because we're all blinded by a view into the future, which causes some uncertainty. So what I want to do is just talk a little bit about, if you had that $1,000, what would you do with it and why? And I think the first thing you need to do before you even put that money towards any stock is you've got to have a reason why. You've got to know what you're doing. Because look, let me just give this to you. Individual stock investing is really for those who believe that they can do better than 9.8% return. Now, why do I use 9.8% return? Well, I use 9.8% return because that's the average that the S&P 500 has delivered over the last 90 years. If you feel you need to do better than 9.8%, then you're going to have to go to the market. You're going to have to learn some things so that you can get into that double-digit range. And if you're going to do that, I'd recommend you go back and watch a video that we have, and it's called How to Double Your Money in the Stock Market in 2019. Get yourself familiar with that video because it will make sense as we go through this video and the next 4 related to the one that I'm doing right now for you. And so if you want those double-digit returns, you're going to have a process because you've got to have something that you can depend on, that you can go through, that you can replicate so that when you do journal, you know why you made the decision that you made because you're following some of the similar steps and processes. So it was W. Edward Deming. He's the father of TQM, which is Total Quality Management. That's what the Japanese put into effect that made the Japanese car manufacturing companies really the darling of the automotive industry back in the 80s, 90s, and early 2000s. And this is what he said, though. He says, if you can't describe what you're doing as a process, you don't know what you're doing. Again, if you can't describe what you're doing as a process, then you don't know what you're doing. Let that sink in. So what I'm about to share with you in this video is a process that I use when I'm considering buying or selling stock. Now, I'm not telling you that you need to use this process, but it should give you some, I'm hoping it stirs some questions in you. It works for me, and I use it. And some of what I'm going to talk about here is not entirely new. I've learned it from some of the best investors by reading those books and attending various seminars. So these aren't new, but what I had to do is some of those great investors like the Warren Buffett, the Benjamin Grahams, Charlie Mungers, these guys play in a little different field than I play in today in terms of the way that they buy today, but the principles are the same. So I took the principles and I adapted them to the way that felt comfortable for me to invest and to win over long term. And again, this is not financial advice. I don't know your situation financially, and so I'm not giving you advice, but what I'm giving you is some information that you can think about it in regards to your own situation, and you may want to do some additional research or seek after an advisor that has your interest in mind. In this video, I'm going to introduce you to this process, and it's really all about just giving you the basis for this understanding as we go through this. And then there's going to be 4 subsequent videos we'll make available in the coming weeks. You'll see those, and those all relate to this video here. Once I've completed the series of 4 videos, I will demonstrate to you how I would apply those and an actual market purchase. All right, let's get into this. So there's 4 criteria that I look at when I'm looking to invest or looking to sell a stock. But we're going to talk about right now is how to buy, because we're trying to help you understand if you had $1,000, where would you put it? And so we're going to give you that. So 4 things to consider when you do that. This video is really about the overview so you get a basis of the understanding of what these 4 criteria are. So when you plump down that $1,000 or 500, how many shares that you wind up buying ultimately, you'll have a better sense of what you're doing and why you did it. I call it the dumb process of stock evaluation. And that dumb process, the D stands for durable competitive advantage, right? And I'll talk about each of these. Number 2 is understanding. Do you understand how the company makes money? Number 3 is the first M, and that's management. Number 4, which is the second M, is margin of safety. So let's take these apart. The top 2 have to deal with more qualitative tests, right? So they're more subjective in nature, and you'll get a sense of that as I go on. The bottom 2 are more qualitative tests, and they deal with numbers. But although they deal with numbers, they don't necessarily mean that they're absolute. And you'll see what I mean. Because when you finish all this, remember I talked about in the beginning, this whole uncertainty thing? Well, that's what we're talking about. But what we want to do is just kind of move ourselves a little closer to feeling better about that uncertainty that we have. And these 4 things help me do that. The first one is durable competitive advantage. So let's talk about that a little bit. Again, this is just an overview. I'm going to get much deeper as I take these on one-on-one in subsequent videos. But a durable competitive advantage is an advantage that the company has against all other market potential competitors. Warren Buffett calls it a moat, right? It's a way to protect the company. So if this is the very thing that they sell and nobody else has it, then they can have higher margins because of it. Is it a sustainable market advantage? That means, can they hold that advantage? Do you believe there's enough evidence showing that they could hold that advantage for 5 to 10 years or more possibly, if they can? So that's a durable competitive advantage. The big thing is, can they protect it? And one of the tools that I use to help me with that is one called a gentleman by the name of Michael Porter. He was he is a professor at Harvard Business School, or at least was. I'm not sure if he still is or not. But he came up with a concept, and it's called Porter's 5 Forces. Now, when I first discovered this business model, I immediately thought I could connect this with the way that I invest or learn to invest. So what it does is it's a business strategy tool that businesses use to help determine if a market that they're going to go into, is it attractive? Does it have the capability of producing higher margins? And so before a big company would decide to go into a market, they would run it through this Porter's 5 Forces model to help them get a better sense of doing that. And so let's kind of take a look at that. So as you can see on the screen, at the top you see threat of new entry. So these are ways that you can gauge whether or not you're really looking at a company that has a durable competitive advantage or not. And so one of that is threat of new entry. Is there a high barrier to entry into this market? Again, the advantage is if there's barriers to new competitors coming into the market to compete with you, you can hold margins higher, right? Higher margins mean more profit. The other thing is there a competitive rivalry that already exists? Is there a lot of competitors in this space already? And if there is, how are you so different that it gives you a competitive advantage? You know, there's some different ones, right? You can have a cost differential, meaning you're able to get things cheaper than everybody else because of your size and your scale. So we'll talk more about those. The other one, as you can see, is supplier power and buyer power. And those, it really comes down to which of these is operating from a position of strength during negotiations. For instance, if I'm Amazon and I want to buy, I'm probably going to buy hundreds of thousands of an item. Because I'm going to do that, when I go to a supplier, I can negotiate better pricing because of my size, and they want that product in my location. So I have a little bit more power in regards to that. So in that case, it's more about buyer power than supplier power. That gives me some leverage in negotiation. The next one is the threat of substitution, and that is how easy is it to find a substitution to my product? Because if it's easy to do, I don't have a competitive advantage because you could default to another product way easier. So I use Porter's Five Forces as a way to help me really dial in whether the company that I'm looking at has a durable competitive advantage. And we'll talk about some examples when I get to that piece and the separate video about how to determine a durable competitive advantage in more detail. Number two is understanding, right? Or understand, meaning do I understand how the company makes money? Because if I don't understand how they make money, I can't figure out when it looks like they might be losing money, right? So I need to know how they make their money. Let me give you an example of this. Well, Amazon, it took me a long time to buy Amazon. It took me a long time because I couldn't understand how a business could run and not make money. There's not a lot of precedence for companies that have done that as long as Amazon did it before they made money. And there was a lot of debt on the books. And that's another thing you'll hear me talk about is my concern over debt. When I would look at that, I just could not find a reason why I would invest. And then one day I was going back to the annual report and I was looking and I uncovered this thing called AWS. I'd seen it before, didn't get it, didn't understand it, but had a little better understanding on the technical side of things with technology. And I found this thing called AWS, right? That's Amazon Web Services. And when you look at that, that's how they really became profitable even before the retail is with AWS, and that's their cloud services. And their ability to, and the size of this AWS, of this cloud service, right? Because they've been collecting data for years, so they've been doing this much longer than anyone else. And so I was like, wow, this is it. And from that point, I looked for a good time to buy, and I got in and I bought. So that's just a good example, and we'll go into more. But number three is management, right? So we talked about having a durable competitive advantage, right? We've talked about understanding the business and the importance of knowing how they make money. And then number three is management. How effective? What is the quality of the management? Well, I could measure that qualitatively, right, to some regards. And in that case, I'm going to look at return on assets because that's important to me. And it's going to show me how much earnings from invested capital, that's the assets that they have in the business, things that they bought, and how effective they are using those to increase the return, right? To drive revenue, to increase revenue. So what are they doing with the current assets that they have, with the assets that they have on the books to grow the business? And the higher that number is, the better. And I like double digits. And we'll talk a little bit more about what I mean in terms of good numbers. But good numbers to me is about 15% or better. And we'll talk about that in more detail the next time. And we'll even talk more about how you calculate ROA. Return on investment lets me know the invested capital that's being put in the company, whether through equity, right, through shares, purchase of stock from the public. That brings cash in. That's one of the reasons that companies sell stock, right? Is to bring in capital that they can go to work with and employ in the business to grow the business. Well, how effective is management, is the CEO with growing, right? Get me a better return on that invested capital. Again, that's another place I like to see double-digit growth and continual growth and a plan for continued growth as well. The other thing I like to look for in management that helps me gauge whether or not I got a good management team is debt. How do they manage debt, both off balance sheet and on balance sheet? Because there's debt that show up on the balance sheet, that's good, but what are they holding on off balance sheet? Now, I'm not gonna get into that just yet. We'll talk about that a little bit more in the upcoming video. But it's important to know how they're managing debt because debt can kill a business, especially if those return on assets and that return on investments aren't growing, but yet the level of debt is. Warning signs all over. Warning, 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 Will Robinson, right? So I'm like, I'm running away from this thing. And number 4 is the margin of safety. And so here I'm trying to determine if I've got a good value, right? So this is that qualitative measure. So I'm trying to, just like the other management is, I'm using some qualitative measures there. So I'm trying to find out, is this a good deal? Well, for me to know if it's a good deal or not, I got to figure out what it's worth. And I want to do it in the most simplified way as possible, because I'm just looking for the map, not necessarily the territory. I'm not going to dial it down to this to the pinpointed area, but what I'm trying to find out generally, where is it at a discount? When is it at a value? When does it reach this thing called intrinsic value? What is the intrinsic value of the stock? What is it really worth? And it's an estimate. And I'm going to tell you, there's multiple ways to figure this out. And there's way too many ways. Some extremely complicated methodologies to do this, and some very simple. And I'm going to tell you, I like simple. Even though I can do all this stuff on a spreadsheet, I want something simple that gives me an idea when it's cheap. And let me just give you an example. I like buckle jeans, right? They're a bit pricey for jeans, but they fit my body the way I like them. So if I was going to a secondhand store, like Savers or something like that, you may not have that in your area, but it's a secondhand store. And so at Savers, let's say I was going through the rack and I spotted a pair of buckle jeans, right? They could be Tyler's, they could be BKE's, but I know that those jeans, I know what they're worth because I buy them. I know that those typically sell between $80 to $100. And so if I see them at a secondhand store and I look at it, I go, man, this thing, they're in good shape. Boy, these look good. They got my inseam. The waistline is right. Then I go, wow, $11. Is that a value? Absolutely. Why do I know that? Because I know what they normally cost, right? Estimated. And I see them for $11, that's a no-lose situation. Well, it's the same thing with stocks. So there's a way to figure out the intrinsic value so that when you're buying closer to what it's actually worth. And then anything below that is considered value, okay? That's value investing. Anytime you can make a purchase below that, right? And then some investors are comfortable with a 10% discount on that stock of its intrinsic value. Other people, they won't move unless they get 15% of below that intrinsic value, and others 20%. You just have to gauge your level of risk based on the uncertainty that we talked about. So there you go. Those are the 4 criteria. We talked about durable competitive advantage, knowing if you have a way to protect. Does that company have a way to protect its advantage in the market? We talked about understanding how the company makes money and making sure we have a clear understanding of that. Again, I've looked at some what I thought were really hot stocks, and I thought, man, I would love to buy this, but I'm reading through the statements, I'm reading through the annual reports. I cannot figure out how they're making money. And so because I can't figure it out, I go, look, there's over 2,000 stocks on the market. I'm going to set this one aside and go find another one, right? Because there's plenty to choose from. And then there's the first M, which is management, right? And we talked about ways to measure the effectiveness of management. And we talked about return on assets. We talked about return on investment. We talked about debt management. And the other thing I didn't talk about, but is certainly important, we'll get into this when we talk about this in a separate video, is CEO pay. You see, because of how a CEO is paid will dictate the incentives or the things that motivate him to get the incentives that the board's laid out for him, which may not always be an advantage to the shareholder. So we'll talk about that as well. So look for the next video. It will be called How to Determine a Durable Competitive Advantage. That's part of this series. We're going to break down the D, we're going to break down the U, we're going to break down the 2 M's, and so that you can use that as markers as you're researching a company before you put those hard-earned dollars down to determine if this is a company you even want to spend time with. And we'll show you which of those you should start with, right? Because you don't want to get into doing a whole lot of work only to find out that, man, I just wasted my time, right? And I maybe only covered 2 of these things, right? I might only covered understanding, and I might have covered margin of safety. So you want to make sure you do these in you may consider doing these in a particular way. So again, look for that video coming up soon, and that's how to determine a durable competitive advantage. And again, if you haven't seen, make sure you look for our video. It's going to be up here or here, and we're going to be talking about there how to double your money in the stock market. It'll be a good reference for you. So by the time you get to that next video, it's going to put you at the starting line ready to win. We'll catch you next time.